Good afternoon. This is Team 6, and we'll discuss the fundamental valuation for Nike. To go over DCF valuation, we'll go over our business story and flowchart, valuation details, and sensitivity analysis in our recommendation. A new strategy for Nike called the Nike Direct strategy involves immersive stores, product innovation, and digital channels, and is paving the way for their future growth. In addition, Nike hired John Donahue, which is a CEO with a tech background. This aligns well with Nike's growing investments in big data, retail tech, and more, such as Nike's recent acquisition of Datalog, a leading data integration platform. These efforts have been fruitful as our 2021 10K shows that Nike's digital segment is their fastest growing revenue stream and R&D spending. Lastly, although COVID was detrimental for many businesses, Nike is well positioned to grow as we enter the recovery stages of COVID due to increased demand for apparel and a 57% increase in people practicing healthy living. The key challenges and threats of Nike include small competitors eating away at Nike's market share. However, Nike benefits from huge economies of scale and is able to invest in tech innovation that creates barriers to entry for other new players. We believe that this innovation will enable them to maintain their competitive advantage and continue to grow despite the threat of new entrants. The second potential threat to Nike that I'd like to discuss is the retail apocalypse. The retail apocalypse is the closing of numerous brick and mortar retail stores, especially those of large chains worldwide. This started around 2010 and continued onward as consumers began to shift towards e-commerce. However, we believe that Nike is equipped to respond well to this threat, given their recently emerging digital strategy. Nike's teams are leveraging website, mobile app, and social media sales to reimagine their sales process, which will enable them to compete successfully in the new e-commerce driven world. In fact, Nike's digital sales soared 82% during the first fiscal quarter of 2021, even as most of its stores were reopened, which is promising news for the firm. Nike is in the apparel, footwear, and equipment industries, all of which have fairly high competition nationally and internationally, such as the companies shown on the screen. Nike is also competing with the large counterfeit market overseas, as well as the company losing as much as 10% of revenue due to fake goods being sold. Despite having strong competitors, Nike still holds the largest market share at 50%. As mentioned earlier, Nike has a strong investment in tech, which can differentiate the company by creating products that may not be easily replicated. For example, Nike has been investing in Nike Adapt, a new kind of self-tying shoe that will be difficult to replicate for companies with low investments in tech. In addition, Nike can maintain their market share because Nike has a strong customer loyalty with exclusive member deals that will increase their membership program. Therefore, we believe that Nike has a strong foundation to compete in this market and continue to experience high growth over the next 5 years. This is our flowchart, which shows important information regarding our valuation of Nike. Though this flowchart is helpful in showing the big picture, we wish to dive deeper into each segment to show the numbers we arrived at and the assumptions we made to arrive at these specific numbers. When calculating the beta to get Nike's cost of equity, we decided that Nike falls into 3 distinct industries, which are apparel, footwear, and equipment. Although these industries are distinct from each other, with different industry players and industry level betas, we still use the same tax rate and DE ratio for footwear and apparel because they're similarly exposed to macro risk. Ultimately, we arrived at a bottom-up beta of 0.93. Next, we used an implied ERP model based on the S&P 500 index and a 2-stage growth model to get a risk premium of 3.7%. Finally, to arrive at the cost of equity, we added the risk-free rate to the product of beta times risk premium to arrive at a cost equity of 5.11%. Next, we computed the cost of debt to be 2.56% based on Nike's A1 AA minus rating by S&P. After calculating the weights of debt and equity based on the market values, we used the WACC formula to arrive at a cost of capital of 4.83%. To find the base year EBIT, we updated earnings to TTM, removed financial expenses from operating expenses by taking out operating lease payments and capitalizing R&D. We chose not to normalize the EBIT because we believe that investments in tech will allow industry growth to continue at the same rate we saw from 2020 to 2021. Thus, the final adjusted base year EBIT we arrived at was 6,161.
After getting a corrected base year operating income, we moved on to computing the base year free cash flow to the firm by adding the adjusted net capex and subtracting the average change in non-cash working capital. The key assumptions made here were using the average change in working capital over the past 4 years because Nike's working capital was very volatile and we wanted to get a more normalized picture of cash flows. The other key assumption we made was related to Nike's current CEO and their tech acquisition strategy. Prior to serving as the CEO of Nike, John Donahoe was the CEO of eBay, where he made 20 acquisitions during his 7-year tenure as CEO. Given his past, we believe that Nike will also adopt a more aggressive acquisition strategy and make on average 2 acquisitions per year going forward. We chose a less optimistic value of 2 acquisitions per year instead of eBay's very high average because Nike has only made 7 acquisitions in its entire life thus far, compared to eBay, who has made over 30 in their life. Additionally, Nike is less reliant on acquisitions, so we believe that 2 acquisitions per year is a more reasonable estimate. Furthermore, Nike's recent history shows a shift towards data, software, and tech investments. Going forward, we believe that Nike will continue to primarily acquire tech-related startups, which sell for an average of about $150 million. This checks out with Nike's acquisition of Select, which was $110 million in 2019. Hence, we can calculate the expected acquisition expense to be 150 times 2 to get $300 million in acquisition expense per year, which we added to net CapEx to depict a better picture of how Nike reinvests for future growth. After completing these steps, we found a final base year free cash flow to Nike of $4,024 million. Now that we have the firm's base year cash flow, we must project how this cash flow will grow over time using the fundamental growth equation shown on the screen. One thing to note is that the denominator of the ROI equation is invested capital, so we added the value of the research asset from our R&D amortization table to the denominator to get a fuller picture of the capital invested when calculating the return on investment. We then multiplied the 2 values to get an overall growth rate of 3.78%, which we will soon apply to the cash flows from year 2 to 5. The last free cash flow that we must get is the terminal value. In order to calculate Nike's terminal value, we firstly had to make an assumption about Nike's ability to generate excess perpetual returns. Given Nike's strong competitive advantages highlighted on the screen, we believe that Nike will be able to differentiate themselves from other athleisure competitors in the long run. Hence, we assumed excess returns of 2% over the cost of capital, which implies an ROC in perpetuity of 6.83%. The second critical assumption we made was about Nike's constant growth rate in perpetuity. No firm can grow faster than the economy forever. So we decided to set the constant growth rate for Nike to equal to the current risk-free rate of 1.68% because the retail and apparel industries are cyclical and typically move in line with the economy. Additionally, we used an assumption of 5 years to maturity, given that Nike is experiencing high growth right now due to new investments, but still faces intense competition from apparel, footwear, and equipment firms both domestically and internationally. We can now use the constant growth rate and the ROC in perpetuity to ultimately calculate the terminal value of $128.8 billion for Nike. We then multiplied our base year free cash flows by the fundamental growth rates to get FCFFs for years 2 through 5. And then putting this all together, we now have 6 years of FCFFs that we can discount back at the cost of capital of 4.83%. This leads to a present value of $120,553 million, also known as the value of operating assets. Before calculating the price per share, however, we must convert the value of operating assets into the value of equity. We did this by adding back an inflated value of cash and subtracting out a broad picture of the value of debt. We decided to inflate the book value of cash to reflect an investor's higher valuation of cash, given that Nike's current return on invested capital is significantly higher than their cost of capital. Additionally, the debt adjustment made here was a very broad picture of debt, including the book value of debt, present value of operating leases, contingent liabilities, accounts payable, and supplier credit that were all holding the value of equity down. Lastly, we did not have to make any cross-holdings adjustments because Nike does not invest in other company stocks. We divided the value of equity of $105.6 billion by 1280 million shares outstanding to get a fundamental value of Nike stock of $82.54. However, Nike is currently trading at $160.48 as of October 22nd, when we pulled the stock price to calculate the market value of equity. Hence, our fundamental valuation suggests that Nike is overvalued by a whopping 198% in the market. Before providing a recommendation, however, we wanted to highlight the sensitivity of our assumptions of excess returns of 2% in perpetuity and the constant growth rate of 1.68%. If Nike is unable to meet excess returns in perpetuity and instead has 0 excess returns, their price per share would go down to $71. However, if Nike manages to do better than we think and achieve an ROC of 10%, which would be 5% in excess returns, and a constant growth rate of 3.5%, then Nike's current market price of $160 could be justified. However, this scenario would require Nike to grow faster than the economy since 3.5% is larger than the current risk-free rate of 1.68%, and this would be very unrealistic given that no firm can grow faster than the economy forever. Given that it is unrealistic for Nike to generate 5+% in perpetual excess returns and grow faster than the economy forever, we still believe that Nike is currently drastically overvalued in the market despite its strong potential for growth as it enters into new direct and digital strategies. We believe that the market prices will ultimately converge to reflect the true fundamental value of $82.54 over time. Hence, we strongly recommend that investors sell their Nike stock now in order to profit off of this market error. I will now pass it off to Nancy, who will be discussing the valuation of Stitch Fix.
Thanks, Rashna. Now we will be transitioning to our valuation of Stitch Fix. This is our flowchart, which shows important information regarding our valuation of Stitch Fix. Though this flowchart is helpful in showing the big picture, we wish to dive deeper into each segment to show the numbers we arrived at and the assumptions we made to arrive at these specific numbers. Compared to Nike, Stitch Fix is a fairly new company as it just went public 5 years ago in 2017. Stitch Fix matches its customers with retail products using its proprietary data created by their in-house data scientists. Ever since the company went public, it's been difficult for Stitch Fix to see a consistent stream of revenue. However, as COVID restrictions are being lifted along with Stitch Fix rolling out new features, we believe that Stitch Fix has opportunities to improve in the future. However, as previously mentioned in the last slide, ever since the company went public, it's been difficult for Stitch Fix to see a consistent stream of revenue. There have been red flags appearing, such as the company's recent C-suite turnover in the high saturated market of incoming online retailers. Future looking, unless Stitch Fix finds a sustainable competitive advantage, then we believe that it will be difficult and take time for Stitch Fix to generate positive and consistent profits. Moving on to calculating the market value of debt and equity. Before calculating the cost of capital, we first had to calculate the market value of debt by treating the book value of debt as a bond to get the market value of debt. We then took the present value contractual commitments like the operating leases and contractual purchases, while also accounting for depreciation. Lastly, we then summed up these two figures to get the total market value of debt. Young companies do not have a lot of debt because it's too expensive. The majority of their market value of debt comes from the large operating lease commitments they have for their fulfillment centers. As for the market value of equity, it was very straightforward in that we simply multiplied the price per share by the total amount of shares outstanding, which led us to a market value of equity of $2.7 million. Moving on to calculating the cost of equity, we first had to calculate a market level implied ERP and a beta for Stitch Fix. When calculating Stitch Fix's beta, we assumed that the company operated in two distinct lines of business, apparel and retail online. Unlike Nike, Stitch Fix does not break down their revenues by these two business lines, so we had to make a personal estimation of how much of their business comes from each industry. Because Stitch Fix's unique value proposition relative to other apparel companies comes from their online algorithms and they operate under more like an e-commerce company than a traditional retailer, we allocated 70% weight to retail online and 30% to apparel. After finding the beta and ERP values led us to a cost of equity of 6.39%. To calculate the cost of debt, we used a modified interest coverage ratio that reflected the current year's operating lease expense and the average projected EBIT over the next 5 years, since Stitch Fix is currently a money-losing company with a negative EBIT. This led us to an after-tax cost of debt of 2.18%, which we then plugged into the WACC equation along with the other calculated figures, which returned to us a cost of capital of 5.68%. Now, calculating the base year EBIT, we had to go through 4 steps. First, updating earnings to TTM. Secondly, removing financial from operating expenses. Thirdly, capitalizing R&D. And lastly, normalizing EBIT if necessary. This led us to a base year EBIT of negative $17.5 million. Now, moving on to removing capital expenses from operating expenses. Stitch Fix values itself in using the most updated algorithm to match its customers with their style preferences. Here you can see that the company states that the company's strength is its client and merchandise database and its data science team with proprietary algorithms is what sets the company apart from competitors. This is the company's biggest asset that will give multiple returns in the future rather than the current period. Therefore, we can remove these costs from operating expenses and capitalize them. Here you can see the amortization table of the data scientist's compensations. We found the headcount for data scientists in the 10K and pulled the compensation from Glassdoor since it wasn't included in the 10K, and found that even though the optimal time for a product to be developed and rolled out is optimal at 1 year, 2 years is more typical and average. This brings us to a total value of compensation asset of $81 million and amortization of compensation asset of $22 million. Now I'll pass it off to Kier to talk more about projecting cash flows to the firm.
Once we adjusted the base year EBIT, it was time to project the future cash flows to the firm. In order to do that, we first had to estimate growth rates and future revenues. Since Stitch Fix is a money-losing company, we had to engineer a path to profitability, which can be accomplished by the top-down growth model. The first step in calculating future revenues was to procure the revenue growth rate. We used the midpoint formula to calculate the growth rates and multiplied each year by 1 plus the growth rate to calculate next year's revenues. This was accomplished by setting the growth rate in perpetuity as the current risk-free rate of 1.68%, which is our target growth rate. Stitch Fix has a large potential for growth because of their investments in their data scientists who simplify user shopping experiences through fashion suggestions. This unique model gives the company a competitive advantage in the short run. However, they may not be able to sustain the growth in the long run due to inventory issues, poor management, and dissatisfied stylists feeling like the algorithms are replacing them. In the past year itself, 4 of the board members of Stitch Fix stepped down, raising more questions about their potential to turn things around. In addition, major competitors such as Amazon and Meta are investing heavily in R&D to make user experience better through the recommendations algorithm. Overall, we believe Stitch Fix is not going to be able to sustain growth in the long run, which is why we will be using a 5-year high growth phase model. Once we calculated revenues, we use expected operating margins to calculate future EBITs. To estimate our operating margin, we first set the target operating margin to be the weighted industry average to maintain consistency with our earlier bottom of beta calculation. Then we calculated the rest of the margins using the midpoint formula and multiplied the revenues by the target operating margins to get our pre-tax EBITs. Since the current operating margin, negative 0.9%, is significantly low, we refrained from choosing a more optimistic target operating margin. Next, we looked at the amount of capital Stitch Fix needed to reinvest in order to maintain growth. To do so, we first calculated the industry-weighted average sales to capital ratio to use as a target, and again, use the midpoint formula. We then multiplied the change in revenues by the sales to capital ratio to get reinvestment per year. We decided to not keep the ratio consistent because we believe that Stitch Fix is going to heavily and increasingly reinvest their capital in order to retain customers as well as broaden their customer base, but the efficiency of these reinvestments will decline over time. The biggest assumptions we made when calculating reinvestment was the gradually decreasing sales to capital ratio. Stitch Fix's growth depends completely on attracting new customers, but they currently have a very inefficient business model and have failed to keep up with customer demand. As a result, they will need to heavily invest capital into building more efficient strategies all across the company. One way to do that is to act more like a traditional apparel company. By focusing more on current trends before solely investing into data-driven algorithms, Stitch Fix can better cater to customer needs and hence drive demand. So, to reflect the shift to a traditional parallel reinvestment strategy, we decided to decrease our sales to capital ratio to the apparel industry average of 1.34 in year 5 as well as in perpetuity. Next, we calculated the future cash flows to firm for the next 5 years, as well as the terminal year. In calculating the FCFF for the next 5 years, we took an aggregate effective tax rate applied to Stitch Fix from the past 5 years and used that number as our value for T. One thing to note is that the 4 years have a negative FCFF and only the 5th year predicts a positive bounce back. Here, we're making an assumption that investors will stay patient and trust the management to turn things around to be more profitable in the long run. However, this does mean that our valuation is a little bit optimistic. Stitch Fix has proven to be very profitable pre-pandemic, and we predict that the company will continue to reinvest capital to make changes to their operations and business model to ensure future growth and profitability. Although this comes with ambiguity, we believe that the immense competition and pressure will help the new management implement changes, although gradually. As Stitch Fix grows, as with any relatively newer company, it will start behaving like a mature company. Right now, Stitch Fix only funds 17.5% of their operations with debt. As the company grows, it will need to fund more of its operations with borrowed capital, which means that their debt to equity ratio is going to increase, and hence their cost of debt will increase since they're borrowing more capital. Furthermore, their beta will become closer to 1, implying stable growth and lower volatility relative to newer firms. Hence, when performing our valuation, we incorporated these characteristics to depict how Stitch Fix will mature over time. Here's the big picture of all the adjustments that were made to incorporate for Stitch Fix's maturity over time. Firstly, we predict that the Stitch Fix's beta will converge to 1.14, which is the weighted industry average for the retail, online, and apparel industries. Additionally, as they borrow more debt, their debt to equity ratio will increase and their cost of borrowing will decrease. So we decided to decrease the cost of debt to 2.19%, which is the weighted industry average cost of debt. As their cost of debt and equity change based on these inputs, so will the total cost of capital. Using the WACC formulas, we adjusted for the cost of capital every year, accounting for the changing cost of debt and equity. Adjusting for the wrinkle effect, we got a cost of capital for year 5 in perpetuity to be 5.25%. We set the new cost of capital equal to ROC since we're assuming that there will be no excess returns generated. Using the formula above, we derived a final adjusted terminal value of $2.93 billion. Next, we got the value of our operating assets using the cash flows to firm calculated earlier and discounting these cash flows back by using their respective adjusted cost of capitals. Finally, we got a value of $1.9 billion for the value of operating assets. Lastly, we adjusted the value of operating assets to get the value of equity using the same process of Nike. Unlike Nike, we decided not to inflate the book value of cash, given that Stitch Fix's current return on invested capital is not higher than their cost of capital. Similar to Nike, we subtracted the full value of debt and did not make any cross-holding adjustments. The total adjusted value of equity was $1.637 billion. In order to calculate the price per share for Stitch Fix's stock, we divided the value of equity we just calculated by 79,000 shares outstanding to get a fundamental value of Stitch Fix's price per share of $20.64. At the time of our valuation in the beginning of October, Stitch Fix's stock was valued at $34.6. According to our calculations, the stock is overvalued by 59.65%. Now, before talking about any final recommendations, we would like to point out two key drivers in our valuation and how they affected our calculated price per share. In our valuation, we assumed a beginning sales to capital ratio of 1.66, which was the weighted industry average ratio for the apparel and the retail online industries. If we assume that Stitch Fix will continue to operate at their current working capital of 2.29, while maintaining an industry average target operating margin of 6.18%, their share price will change to $22.19 per share. However, this will not be a profitable move for the company given the importance of reinvestment for their future growth. Now, if they weren't able to meet the industry average target operating margin and work toward a 4% target operating margin, their share price would drop to $10 per share. In order to have their share price as of October 8th to be justified, they would need to hit beyond the industry average target operating margins of 10% and reduce their initial sales to capital ratio to 1.37, which is too optimistic and a little bit unrealistic given their current operating margin of negative 0.9%. Our final recommendation is to sell Stitch Fix stock. Even though they show promise to grow and are a fairly young company, we believe that Stitch Fix will not be able to sustain growth due to intense rising competition and their management issues. As observed today, their market price is listed at $24.97, which is already close to our valued price per share of $20.64 as compared to the $34.6 initial starting point. Thank you for your attention, and we wish you the best of luck investing.